Every year, investors chase the same handful of high-flying tech giants, only to overlook the quieter opportunities right in front of them. While the spotlight shines on companies that are already priced for perfection, the most compelling gains often come from stocks that are temporarily misunderstood, undervalued, or simply waiting for their next big catalyst. As we move toward the end of the year and look ahead to 2026, the market still holds several under-the-radar names that could deliver impressive returns with calculated patience. These companies span different sectors, from industrial innovation to cloud software and digital infrastructure. Yet they share a common element. Their true potential hasn't been fully appreciated by the market, at least not yet. One compelling example is 3M Company, known most famously for consumer and industrial products like Post-it notes and Scotch tape, but far more importantly for advanced material science and manufacturing technologies that play critical roles in industries ranging from healthcare to aerospace. Over the past couple of years, the company has faced legal challenges and operational setbacks that pushed its share price lower than what long-term fundamentals might justify. That's exactly why many contrarian investors are quietly accumulating shares. With the stock trading in a range recently around $160 to $170 per share, the valuation looks modest compared to historical levels where 3M has previously hovered well above $200. The company has been restructuring aggressively, cutting costs, refining its business units, and investing in more profitable segments aligned with future industrial demand. If these initiatives continue to take hold and global manufacturing stabilizes or rebounds, it isn't far-fetched to imagine 3M regaining momentum and climbing back toward $200 or even $210 by 2026, particularly when you also factor in its strong dividend yield, which sweetens returns for patient shareholders. The beauty of a company like 3M is that you're not betting on hype. You're investing in a century-old innovator that has proven resilience through economic cycles. Shifting from industrials to business services gives us another underrated gem: automatic data processing, widely known as ADP. At a share price recently sitting in the $250 to $265 range, ADP may seem fully valued at first glance. But what the market often forgets is that this company is a quiet powerhouse, deeply woven into the global economy's infrastructure. Every time a paycheck is processed, a worker is onboarded, or a major corporation updates its HR system, there is a good chance ADP is involved behind the scenes. That level of dependency creates exceptional revenue stability, and switching to another provider is both costly and disruptive for customers, enhancing ADP's moat. This is the type of business investors usually flock to during uncertain markets, yet today it has been overshadowed by flashier software names. The company has been steadily improving margins, introducing automation and AI tools into payroll and compliance solutions, and expanding globally. With consistent earnings growth and decades of dividend increases, ADP could reasonably see its stock rise toward $300 to $320 within the next couple of years if corporate hiring improves and businesses continue digitizing back-office functions. It may not be a rocket ship, but it offers a reliable runway of growth that could reward shareholders with lower volatility and steadier returns. For investors seeking more excitement and greater upside, one name that deserves attention going into 2026 is Workday, the cloud software provider specializing in HR, payroll, and financial management systems. Workday has carved out a powerful position in large enterprise back-office transformation and continues to win customers transitioning away from legacy on-premise software. Its stock has been hovering somewhere around $230 to $250 recently, still below the optimistic expectations some analysts once placed on high-growth cloud companies. But the shift toward AI-enabled enterprise productivity is only ramping up, and Workday has already begun integrating predictive and automated tools into its offerings. As long as the company continues expanding into new industries and mid-market customers, while maintaining strong subscription renewal rates, there's a justifiable case for Workday approaching $300 to $330 or more by 2026. Workday tends to appeal to growth-minded investors willing to tolerate short-term volatility in exchange for long-term scalability. Yes, the valuation sits higher than more mature industrial names, but its addressable market, modernizing global financial and workforce systems, still offers significant expansion runway. If cloud spending accelerates in the coming years, Workday could easily surprise to the upside. Of course, building a future-proof portfolio means thinking about infrastructure, not roads and bridges alone, but also the digital backbone that all modern technology depends on. That's why American Tower Corporation stands out as another underrated contender for 2026 growth. A leading owner of wireless communication towers around the world, the company benefits from increasing data usage, 5G deployment, and the never-ending demand for improved connectivity. Shares have recently sat in a range close to $180 to $200, which is meaningfully below highs the stock reached when enthusiasm around 5G first peaked. Since then, rising interest rates weighed heavily on tower REITs due to their debt-financed business models. But if borrowing costs ease over the next year or two, American Tower could see substantial relief. The underlying business remains strong. Wireless carriers must keep expanding networks to handle bandwidth growth, and American Tower collects long-term rental revenue independent of which telecom company wins the competitive battles. As data consumption continues to surge globally, particularly in emerging markets where American Tower is expanding, it's not unrealistic to foresee the stock advancing back above $230 to $250 by 2026 while continuing to pay an attractive dividend. Then there's the semiconductor space, an industry that remains at the heart of technological innovation, from AI to electric vehicles to consumer electronics. One compelling pick flying a bit below the radar compared to megacap chip leaders is NXP Semiconductors. Best known for chips used in automobiles, secure identification, and industrial systems, NXP benefits heavily from growing automation, electrification, and intelligent vehicle technologies. The stock has traded recently around $200 to $220. And while that's not cheap in absolute price terms, the market often undervalues how deeply integrated NXP is in the future of mobility. As supply chain challenges ease and automakers push to include more high-performance chips in every new model, not just EVs, the revenue opportunity expands rapidly. With automotive computing becoming a central selling point rather than a cost necessity, NXP could see earnings accelerate faster than the broader chip sector. If that plays out, a move toward $250 to $280 over the next couple of years becomes quite plausible, especially if investors begin recognizing the company as a direct beneficiary of the AI-driven smart vehicle wave. To round out this search for underrated opportunities, one can't ignore the unstoppable transformation in healthcare and biotechnology. A standout here is AbbVie, a pharmaceutical leader with strong cash flow and a robust pipeline of treatments. Even with a series of patent expirations on some of its major drugs, AbbVie has continued diversifying its portfolio through successful product launches and high-potential research developments. The stock has often fluctuated in the $140 to $160 range, which some long-term investors consider a discounted zone when measured against future growth prospects. The company's advancements in immunology, neuroscience, and aesthetics could drive significant new revenue streams heading into 2026. Coupled with a notably high dividend yield, AbbVie offers a blend of value and upside, a combination increasingly hard to find in large-cap pharma. Should pipeline successes gain momentum and healthcare market spending remain strong, AbbVie returning to the $170 to $190 range seems well within reach. What unites these companies is that none of them require a perfect economy to succeed. They sit in industries that underpin the global system: manufacturing innovation, workforce digitalization, mobile connectivity, intelligent transportation, and medical breakthroughs. They are not solely dependent on consumer fads or speculative narratives. Instead, they each possess tangible advantages: durable demand, loyal customers, intellectual property, sticky ecosystems. That should persist regardless of near-term volatility. Yet today, the market has not fully priced in their future potential. Investors often overreact to short-term uncertainty, overlooking businesses that are quietly strengthening, restructuring, or advancing new technologies behind the scenes. When sentiment shifts, and it always does, these overlooked companies can suddenly become market favorites again. Buying before that narrative reversal is how smart investors position themselves for compelling returns. As we approach year-end and begin planning for 2026, the key is to balance conviction with patience. The most successful long-term investors don't chase what's popular today. They identify what will matter tomorrow. Whether you prefer the steady yield and industrial strength of 3M, the defensive business model of ADP, the cloud-driven growth of Workday, the digital infrastructure backbone of American Tower, the automotive technology leadership of NXP Semiconductors, or the healthcare innovation pipeline of AbbVie, each offers a unique opportunity to buy into future growth before the rest of the market wakes up to it. Timing the market is nearly impossible, but timing market sentiment shifts is where hidden gems emerge. Right now, these companies are quietly aligning for growth that could shine far brighter by 2026. For investors willing to look beyond the headlines and dig into fundamentals, the final months of the year present a chance to secure positions in some of tomorrow's success stories, while they're still underrated today. That was all from us today for this video, folks. For more similar content, make sure to watch our video on 5 stock market myths keeping you broke. See you in the next one.